Here's a number that should stop you mid-scroll. One single company is now worth more than the entire annual economic output of Germany, the third largest economy on Earth, a country of 84 million people, with factories, exports, an entire manufacturing base built over decades. One company, more valuable than a whole G7 nation. And it's not even close to alone. Add two more tech giants, and you've got a combined valuation bigger than three G7 economies put together. Is that insane? Is that just how markets work now? Let's ground this in real numbers, because trillion stopped meaning anything to most people a long time ago. As of mid-May 2026, Nvidia's market capitalization hit $5.7 trillion. For comparison, Germany's entire 2026 GDP, everything the country produces a year, is projected at $5.45 trillion, according to IMF data. Nvidia has surpassed Europe's largest economy, not close to it, past it. Zoom out further, Nvidia is now worth more than the annual output of every country on the planet except two, the United States and China. Now stack a few more names on top. Alphabet sits around $4.34 trillion. Apple, around $4.3 trillion. Put those three tech companies together, Nvidia, Alphabet, and Apple, and you're looking at a combined value north of $14 trillion. Compare that to three G7 economies, Germany $5.45 trillion, the UK $4.26 trillion, and France $3.6 trillion. Combine, those three countries produce about $13.3 trillion a year. Three tech companies are now worth more than three entire G7 nations combined. So how do you even get a number like that? Let's break down what market cap actually means, because this is where most people get confused. Market capitalization isn't cash sitting in a vault somewhere. It's simple math, share price times the number of shares outstanding. It's not what a company has, it's what investors collectively believe the company will be worth in the future, based on the profits they expect it to generate for years to come. Here's the analogy. Imagine Andy again, except this time, Andy owns a small bakery that made $10,000 in profit last year. If someone offered to buy the whole bakery for $10,000, that would track roughly with what it earns. But if someone offered $500,000 for that same bakery, they're not paying for what it makes today. They're betting on what they think it'll make in 20 years, if it becomes the biggest bakery chain in the country. That's Nvidia's stock right now. Investors aren't just pricing in this year's chip sales. They're pricing in a bet that AI computing demand keeps compounding for a decade or more, and that Nvidia keeps its dominant position the whole way through. And that dominant position is real, at least for now. Nvidia's fiscal 2026 sales hit $215.9 billion, up 65% year over year. And CEO Jensen Huang has said the company has more than $500 billion in AI chip orders booked through 2026, what he called unprecedented visibility into revenue. GDP measures something completely different, the total value of goods and services whole country produces in 1 year. Comparing GDP to market cap is like comparing a company's yearly paycheck to someone's estimate of its entire future net worth. They're not the same kind of number, but the comparison still tells you something real about scale and concentration. Let's widen the lens one more time, because the Nvidia number alone actually understates the story. Zoom out to the Magnificent Seven: Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla. Combined, these 7 companies are worth more than $20 trillion. The European Union's entire GDP minus 27 member countries combined sits at roughly $18 trillion. Read that again. 7 American companies are worth more than the combined economic output of 27 nations. And the pace this happened at is what should really catch your attention. Apple took almost 4 years to go from $1 trillion to $2 trillion in market cap. Nvidia went from $1 trillion to $3 trillion in about a year. It hit $4 trillion in July 2025, then $5 trillion, roughly 3 months later. That's not gradual growth. That's a curve going vertical. Deutsche Bank estimated that when Nvidia was only worth around $4 trillion, its valuation alone represented approximately 3.6% of entire global GDP. One company, nearly 4 cents of every $100 the entire world produces a year, captured in the value of a single stock. For context on scale, the global economy is projected to produce about $123.6 trillion in total output in 2026. A handful of AI-linked companies now represent a genuinely significant slice of that number, concentrated in a way markets have simply never seen before. Here's why this isn't just a fun trivia fact, it's a real structural risk. If you invest through a broad index fund, there's a very good chance Nvidia is already one of your largest individual holdings, whether you picked it or not. These mega-cap AI stocks have become such a heavyweight in major benchmarks that their moves single-handedly drag entire indexes up or down, even when most other stocks in the index are flat or falling. Follow the incentive here too. Fund managers benchmarked against these indexes have every reason to keep holding these stocks. Underweighting Nvidia relative to the index is itself a career risk for a portfolio manager, even if they privately think the valuation is stretched. Index providers don't have an incentive to flag concentration risk either. More assets flowing into passive funds is good business, regardless of how top-heavy those funds become. Who's actually exposed to concentration risk without necessarily knowing it? Anyone with a retirement account in a standard S&P 500 index fund. The index doesn't warn you when it quietly becomes a bet on a handful of AI companies instead of the diversified 500 companies story is sold as. This is also why coverage of these numbers tends to stay shallow. Nvidia hits new record high is an easy, exciting headline. It's a feel-good story about American innovation, and it drives clicks because the number keeps getting bigger. 7 companies now represent economic concentration comparable to the combined output of 27 nations. And most retirement accounts are more exposed to this than investors realize. It's a much harder story to tell in a headline, and a much less comfortable one for an industry that profits from continued inflows into these same stocks. It's not that financial media is hiding anything. It's that line goes up is simple, and structural concentration risk building quietly inside your 401k requires actually sitting with the numbers for a minute. Most headlines don't get that minute. So, does it make sense? A handful of companies worth more than the entire G7 economies combined? Maybe. If you genuinely believe AI transforms the global economy the way electricity or the internet did, this concentration might just be an early snapshot of where value naturally accumulates. Or maybe it's a sign that markets have priced in a level of certainty about the future that no technology has ever actually delivered on schedule. I'm not telling you which one is true. Nobody actually knows yet, no matter how confident anyone sounds. But I am telling you, check how much of your own portfolio is quietly riding on 3 or 4 ticker symbols before you assume you're diversifying. Ask what you're actually betting on. Check the concentration behind the index. If this number changed how you think about your own investments, subscribe, because we're going to keep breaking down what these headline numbers actually mean underneath the hype. And drop your take in the comments. Does this level of concentration end in a historic payoff or a historic correction? See you in the next one.